I would like to start with Mr. De Swan, if you don't mind. And I would like to ask you a question about the interest rate environment. So it has been, we have been having very low interest rates for quite a while. And what are your expectations looking forward? And the second question is, what is the impact of such a low interest environment on the financial markets?
A bit strange to talk about low interest rates in an environment in a country like this where you can hardly talk about low interest rates. But if I talk about low interest rate, I talk about real low interest rates. And also, if you look at the rate curve here in Turkey compared to inflation, you could call it that you have relatively low real interest rate. But in most countries, and especially in the country I'm from, so the Eurozone, interest rates have been exceptionally low over a very prolonged period of time. I don't think that in the recorded history, maybe the short period after the Second World War, we have seen such a prolonged period of extreme low interest rates. And the interesting point is that I don't see any end of that in sight. I mean, if you look at the policy by the European Central Bank and the words Mario Draghi used only a couple of weeks ago to give his view on the economic environment in the Eurozone and his prediction, well, officially, obviously, he doesn't give a prediction, but the indication he gave as far as his view on interest rates is concerned, it's clear that there is no end, and that is going to impact, is impacting already financial markets and especially financial institutions quite. The second point is a very strange phenomenon that while technology is increasing rapidly, productivity seems to be growth seems to be extremely sluggish. We don't see technology investments, which have been phenomenal, being translated into productivity growth. That is another factor which is very difficult to explain. This is true for the whole Western world. It's not only Europe, but it's also the United States, where you don't see these high investment levels in technology leading to increases in productivity. And then a phenomenon that we have seen before but has been very remarkable over the last year is the demand of safe assets. After the financial crisis, large investors, and when I'm talking large, I mean countries building up foreign currency reserves, which has been especially marked after in Asia, all these countries go into very safe assets, leading to extremely low interest rates in that field. For banks, especially those banks that are very active in the mortgage markets, it's also tough times. It's very difficult to, for example, get 30-year money in order to be able to extend 30-year mortgages. So you have to find derivative options to cover for long-term mortgages, and the market is hardly there. So you see a shift from long-term mortgages from the banks to life insurance companies and pension funds, leading to a pressure on the profitability of banks. But the pension funds themselves are also confronted with a big problem, namely that they have to calculate their liabilities on real interest rates, on actual interest rates, so nominal positive interest rates.
Thank you. I would like to continue with another popular subject, if you don't mind. This time, Sherwin. Brexit, which is very popular. UK political scene is changing nowadays. So what is the impact of a potential Brexit to UK economy, EU economy, globe in general, businesses, and what are your expectations? What's going to happen next?
The expectation is that, of course, the United Kingdom will continue to do okay, but a lower growth rate. Probably in the area of 1.2% rather than perhaps the 1.7, 1.8% that we had been going at before. What will it mean for Europe? I think the loss of the United Kingdom is not so much only economic. It's also the United Kingdom has been a relatively more open economy, has in fact espoused views which are more akin to those of the United States: open markets, open economy, multilateralism rather than bilateralism, and so on. So it will have an effect on Europe, more on the attitude that Europe may have to the rest of the world. In relation to all of that, I think we face in Europe a real problem, and that is that we are still fighting to some extent the 1418 war by having United Kingdom go against Germany, or France going against somebody else, rather than looking at Europe as a whole. It hasn't happened yet, and I think if one was purely in the private sector and one was looking at Europe, one would be saying, what over a 10-year period where is the competition going to be? Strategically, I think the competition is going to be Asia and North America, and perhaps even longer term, maybe some other power blocks, economic power blocks, rather than that the competition for Europe is each European nation. And I think we have to raise our sights in Europe a bit to think of what the future actually holds for Europe, rather than what the future holds for each one of our countries.
Are you observing any precautions on the global company side, migration to different cities, and are you observing this, or is the scale big, low?
Planning is actually quite expensive. On the other hand, financial institutions have had to plan for the worst, just as we did in the year 2000. In the year 2000, Y2K, we all planned for the worst. It didn't happen. I think very few CEOs, very few boards actually will now say that planning and the amount of money that we spent to plan for the worst, which didn't happen, was money ill spent. We all actually believe that it was the right thing to do. It didn't happen, but it was the right thing to do. And I think financial institutions in particular, but also some manufacturing institutions, companies and organizations are planning for the worst, and we'll have to see whether it improves on that.
Excellent. What are your expectations? So how are we going to resolve this issue globally?
The US administration, which seems to pick fights with everybody, friends and foes, seems to revert to some sort of mercantilism that hadn't been seen for a long, long time. But if we cut through it all, I agree with Win there. I think that the substance of what's going on is really what's happening between the United States and China. I mean, I think that's where the main focus should be here. And for all the nice pictures that we're going to see this weekend of, you know, the two leaders meeting in Japan, and the big headlines about reconciliation and so on, I'm afraid that the situation is a lot more complex. And I don't think that there is a simple deal that can effectively bring to a close the situation. And there's essentially two factors here to think about. One is that we're assisting to a major rebalancing of power in the world. The reality of the matter is that the Chinese economy in nominal GDP is now 16% versus the 24% of the United States. And if you look at it on a purchasing power parity, actually it's bigger. So I think that is you know, the whole America First doctrine of Trump kind of reflects this reality. And I'm not sure that America is willing anymore to just underwrite the liberal order internationally by opening its market without having some degree of reciprocity. So that's one issue. The second issue, I think that there is a growing perception in the US that China has a system of the single-party dominance of the control of the economy, and the state-led capitalism means that it's placed by completely different rules than what the US has, and it puts the US at a systematic disadvantage. The US have a little bit of the upper hand here in some ways. I think that the economy, of course, has done very, very well. although it's softening up a little bit. I think that China is wary of putting in danger, decades of development by potentially, throwing them off course. China cares more about its exports to the U.S., I think, than the U.S. care about the imports from China. But anyway, we'll see where that goes. I think from the standpoint of the financial markets, the reaction to trade wars has not been very consistent. If you look at last year, if you look at this year, the truth is that if you take away the volatility, and now we're used to 200 points in the Dow per day is kind of nothing, the markets have actually taken this entire thing kind of in their stride. The Dow has doubled in the last couple of years. If a prolonged trade war were to trigger an actual slowdown in the world economy and a potential fall in the US stock market, I think that the Trump administration in particular would look at things in a different way. The truth is we have an election in 2020. The loop of economy to market to politics in America is quite strong and powerful, much more than in China, of course. And so I think there's a question there. The bottom line is that these two countries are more than 40% of the world output. They have to find a solution for a new relationship, or how to reset the relationship. And they have to share the burden, I think, to do so. So I hope there'll be flexibility and mutual compromise for all of us.
What are the opportunities and challenges for emerging markets? And in addition to this, do you have recommendations for Turkey at this time to pull some of that opportunity towards this region?
On low interest rates first, I think emerging markets are extremely fortunate to have relatively low interest rates, given the growth that needs to be financed. For the developed markets, I think it's horrible to have low interest rates. We have got an enormous amount of liquidity. That liquidity has to be employed, as Tom said before, and it is employed increasingly in assets which have got problems. Develop their own economies. Their trade within the emerging markets, I think, is increasing, particularly in Asia. So I think that's a positive side of it. What about Turkey? Well, as Tom mentioned at the beginning, Turkey, of course, hasn't got low interest rates. It has got, but I think it is right to think of real interest rates rather than low interest rates. And I suspect that as inflation comes down, which I think it will, there's even popular pressure in countries where there is high inflation for the inflation to be dealt with, and that will actually then lead to lower interest rates. So I fully expect interest rates to come down. In the meantime, of course, it's a question of how Turkey finances itself. And it does finance itself, of course, through the foreign currency markets rather than its own savings. And savings are relatively low in Turkey. And that is a problem, that if you're wholly dependent on the foreign markets.
Advantage emerging markets as far as low interest rates is concerned. I fully agree with that. I think I would like to add one thing. What we have seen over the last 2 years is a substantial increase in volatility in the markets, and that obviously doesn't favor. What the emerging market needs are long-term flows of foreign direct investments, which can be done at relatively low interest rate. But the point is that investors are very jittery to any move in interest rates and shifting money away from one part of the world to the other in order to gain some pickup in yield, and that obviously doesn't help emerging markets. But theoretically and in practice as well, emerging markets benefit from low interest rates. My more, let's say, structural view on Turkey is concerned. I know that the economy at this point of time is in somewhat of a bind with extremely high inflation, high interest rates, and a problem in too low foreign currency reserves to have a good and a solid monetary policy. But my view is much more structural, that this is clearly a country which has huge potential.
Well, I would say that there's a little bit of an opportunity. Traditionally, emerging markets have suffered when the U.S. have increased interest rates, the dollar has gone up, We've seen capital outflows and then currencies under pressure and so on. That seems to have kind of slowed down. We're not really back in a path. It was for the few months of expectation, but now it looks like rates aren't going up anytime soon in the United States. So I think that's a bit of an opportunity. It's probably going to go lower because of the trade war in some ways, and many emerging markets depend on exports, of course, for the growth of their economy, particularly to China. So that may be an issue in terms of commodities and intermediate goods. But overall, I think it's an opportunity for emerging markets. And I think it's an opportunity for Turkey, to be honest, because Turkey can differentiate itself, possibly by addressing some of the policies that have made it a bit more vulnerable in the past. And I'm thinking about, the lax monetary policy, frankly. That's something that probably needs to be addressed, the current account deficit and so on. But also for companies, I think that Turkish exporters are going to do very well. I think that there are companies here that have better governance, that have better risk management than many companies in other emerging markets. And I think that Turkey should continue to invest in that respect to differentiate itself.
Now, I would like to discuss a little bit about technology. So nowadays, for the last several years, we have been talking about fintechs, big techs, neobanks, cryptocurrencies, you name it. So, what is your prediction, looking forward? And this time, I would like to start with
technology point of view. It's absolutely staggering. I'm a firm believer in the strength of incumbents. If I look at the large financial institutions like Akbank or maybe an Emro or Citibank or whatever, they have a huge competitive advantage because they own the customer and have the data. So by definition, new startups, new technology companies, fintech companies lack those strong bases incumbents have. So the natural tendency of these small startup fintech companies is to develop themselves into a technology phenomenon, technology feature, an app or a payment system, and then seek cooperation or joint ventures or even a takeover by large existing incumbent institution, which, by the way, have to transform themselves. You just can't sit and wait until they come. You have to be open-minded and reach out to these companies and see whether you can cooperate with. If I may give one example of my own company, we developed a payment app only 1.5 to 2 years ago, in which we had predictions together with a fintech company. So in a joint venture where we had, fortunately, with the benefit of the hindsight, a fixed majority of the financials. And our idea was that we would have 60,000 customers at the end of the first year. At the end of the first year, we had 4.5 million customers. And so this can develop so quickly and spread so quickly that you have to be able, as a large incumbent financial company, you have to adjust yourself. But it remains the fact that we have a treasure in our in-house, namely the customers and the data about the customers. If we can use that well, I firmly believe that incumbent companies can survive and actually thrive very much in the technology sphere.
What is big? The market cap of Deutsche Bank today is $15 billion. The market cap of Microsoft yesterday was over $1 trillion. Yeah. So I think the moment these people decide to move into the financial segment, which they have, it's going to be brutal. These people have the technology. They have acquired customer relationships on a variety of things. They own the data. They know what to do with the data. The moment they come in, they will just pick the banks, buy them up, and use them as they want. Yeah. The issue, I think, is for the incumbents to try to figure out what to do, but the issue is going to be for the regulators, for what it means in terms of fiscal systems. I think the world is going to see some very big changes. I think incumbents traditionally have been quite slow. need to get going.
I think there is, obviously, amongst the technology companies, they wouldn't want to be regulated the way their banks are regulated. We're very highly regulated, and we're highly regulated, more highly regulated than we were because we failed in many cases. And that's because if we hadn't failed, I think that would have been... I think the incumbents have got a tremendous advantage. I agree with that. The disadvantage is that they're mostly, and I know this from JP Morgan and others, we're working off very expensive systems, legacy systems, and the cost base, therefore, that we have in relation to our existing business is really quite high, and that can be undercut. There is no doubt about it. Can these undercutters, though, reach the kind of scale, because what we have is scale, whether that's Akbank, whether it's DBS in Singapore, whether it's HSBC in Hong Kong, or whatever it is, or the Chinese banks, they do have the scale, and these people find it very difficult. In the United Kingdom, it's very interesting that while we've had 50 banking startups in the last 5 years, the market share of the top 5 banks, I was chairman of Lloyds for some time, which is the largest in the domestic market, is still 85%. This is the scale effect is very difficult to go against. On the other hand, the cost side of it is tremendous. But can you get the kind of scale? Can you get people to switch? And can you get people to switch not just for 5% of their free money that they might give into a payments operator or whatever it is? When will they switch to put their salaries, their dividends, and so on into these kind of companies? And I think that's going to take some time. So, agree with you to some extent, but the incumbents do have a real problem on their cost base.